Okay, so today we're diving deep into Levi Strauss & Co.'s latest quarterly report.
Right?
We've got the earnings release right here, hot off the press from October 2nd, 2024,
Okay.
and we're ready to break down their performance.
Yeah, there's a lot to unpack here.
Right.
It's a bit of a mixed bag for Levi's this quarter.
Okay, interesting. So let's get into it.
Yeah.
The report highlights some pretty positive numbers for their flagship Levi's brand,
Mm-hmm.
with global revenue up 5%.
Right.
That's their strongest growth in 2 years, and a significant jump from earlier this year.
Yeah.
What's fueling this resurgence?
What seems their strategy of connecting directly with consumers is paying off.
Okay.
Their direct-to-consumer sales,
Mm-hmm.
meaning their own stores and website,
Right.
surged by 12% in the U.S.
Wow.
This suggests that their investments in enhancing their online presence and customer experience are yielding results.
That makes sense. They've really been upping their game online.
Exactly. And there's more good news
Oh,
from across the pond.
Oh.
Europe is showing strong performance with revenue up by 7%.
Okay.
This indicates that their targeted efforts to appeal to younger European demographics with more contemporary styles are gaining traction.
Okay, so while Levi's is enjoying a comeback, the same can't be said for their other brands, particularly Dockers.
Right.
What's the story there?
Unfortunately, Dockers had a rough quarter with sales plummeting by 15%.
Oh, wow.
And it's not just a temporary setback. This downward trend seems to be part of a larger issue, as Levi's also announced in this report that they are considering selling the Dockers brand.
Now, that's a significant shift.
Yeah.
What kind of signal do you think this sends to investors about Levi's long-term strategy?
It suggests they're moving towards streamlining their portfolio and focusing on their most profitable brands, potentially even at the expense of iconic names like Dockers.
Yeah.
But before we dive deeper into the implications of that,
Okay.
let's shift gears and talk about Levi's overall profitability.
Okay.
Their press release highlights an 18% jump in adjusted diluted EPS,
Okay.
which landed at $0.33.
Okay.
What should we make of that number?
For those of us who aren't financial analysts, could you break down what adjusted diluted EPS actually means for a company's bottom line?
Of course.
Thanks.
In simple terms, earnings per share, or EPS, is the portion of a company's profit allocated to each outstanding share of common stock. Diluted EPS takes into account the potential for the number of shares to increase, like if stock options are exercised.
Okay.
Adjusted means they've made certain exclusions to give a clearer picture of their ongoing performance.
So it's a way to gauge their profitability on a per-share basis,
Right.
with some adjustments to account for potential variation.
Precisely.
Okay.
However, it's crucial to remember that adjusted earnings often present a rosier picture as they can exclude certain costs.
Right.
In this case, they've excluded a substantial $111 million impairment charge related to their Beyond Yoga brand.
So Beyond Yoga isn't looking so zen right now.
Not exactly.
Okay.
This impairment charge means they've had to acknowledge that they overpaid for Beyond Yoga when they acquired it.
Wow.
Essentially, they are writing down the value of the brand to reflect its actual worth.
Ouch, that has to sting.
Yeah.
What implications does that have on their financials, and why should our listener care?
In practical terms, it means their assets are worth less than they initially thought, which can impact investor confidence.
Right.
For the listener,
Yeah.
it raises questions about Levi's acquisition strategy and their ability to accurately assess the value of potential purchases.
Yeah, that's a really good point. This Beyond Yoga situation definitely raises some questions about their overall strategy, but before we get too far into that,
Sure.
let's circle back to their financial outlook.
Okay.
Even with the Beyond Yoga write-down, their guidance for the full year remains unchanged.
Right.
Adjusted diluted EPS in the range of $1.17 to $1.27.
Mm-hmm.
Does
Oh.
that mean they're feeling cautiously optimistic about the rest of the year?
It appears, so they seem to be banking on the continued success of Levi's to offset any further bumps in the road with Dockers or other brands. Another positive sign is their strong gross margin, which sits at a healthy 60%.
60%. That's impressive. What's contributing to such a strong margin?
It's largely due to lower product costs and what they call a favorable mix of channels and brands.
Yeah.
Essentially, they're becoming more efficient at managing their expenses and selling a higher proportion of their higher margin products.
Which makes sense if they're streamlining their brand portfolio and focusing on what's working.
Right.
Now let's zoom in on some other key figures from their financials.
Okay.
Their balance sheet shows $577 million in cash on hand,
Right.
and their total inventory is down 7%.
Yeah.
What can we learn from these numbers?
Those are both encouraging indicators. Having a healthy cash reserve gives them flexibility, especially in uncertain economic times. It allows them to invest strategically, weather potential downturns, or even make further acquisitions if the right opportunity arises. And lower inventory levels suggest they're managing their supply chain efficiently, avoiding an overstock of unsold goods which can eat into profits.
Right, so they're being very strategic with their
Yeah.
resources, and they're clearly committed to delivering value to their shareholders.
Mm-hmm.
The report mentioned they paid out $52 million in dividends this quarter.
That's right. And they also bought back $18 million worth of their own shares. These actions demonstrate their commitment to rewarding investors and signal confidence in their future growth potential.
All these pieces are starting to paint a clearer picture of where Levi Strauss & Co. stands. They're navigating a tricky market with some bold moves,
Right.
but there are definitely some challenges ahead.
That's
It feels like they're at a pivotal moment in their journey.
Absolutely. What I find fascinating here is that they're not shying away from taking risks. They're streamlining their portfolio, doubling down on their strengths, and even willing to part ways with a legacy brand like Dockers, all in a bid to stay competitive. However, they're making these decisions against a backdrop of significant change in the apparel industry as a whole.
So how does this broader context factor into their strategy?
Yeah.
And what does it mean for their potential for success? That's a great point, what's happening in the apparel industry right now that makes Levi's move so risky but potentially so important.
Well, the apparel industry as a whole is facing some serious headwinds.
Right.
Inflation is putting pressure on margins, consumer preferences are shifting rapidly, and there's a lot of uncertainty in the global economy. It takes a lot of agility and a clear vision to navigate these turbulent waters.
So Levi's is making these big decisions in a pretty unpredictable environment
Right.
that makes their bet on Levi's even more interesting. But is it the right move? I mean, Dockers might be having a rough time, but it's still a well-known brand with a loyal customer base.
Sure.
Could they regret letting go of that?
It's certainly possible. This raises an important question for our listener.
Okay.
What does Levi Strauss & Co. want to be known for in the future? A diverse portfolio of brands, or a laser focus on their flagship Levi's brand? Their potential sale of Dockers suggests they are choosing the latter, betting on the strength and recognition of their core brand to carry them forward.
It's a tough call for sure. They've got to weigh the potential short-term gains of a Dockers sale against the long-term impact on their brand identity and market reach. What do you think will be the deciding factors in their decision?
Well, they'll need to carefully consider the potential sale price of Dockers against its future earning potential.
Right.
If they believe they can get a good price for it now and reinvest those funds in areas with higher growth potential, like their direct-to-consumer channels or international expansion, it might be a smart strategic move.
Okay.
They'll also need to weigh the risk of losing market share in the casual apparel market if they divest Dockers against the potential upside of becoming a more focused and profitable company.
So what does this all mean for our listener? What's the key takeaway from this deep dive into Levi's recent performance?
The big takeaway here is that Levi Strauss & Co. is at a crossroads. They're making bold moves to streamline their operations, focus on their core brand, and adapt to a rapidly changing market. Whether these decisions will lead to long-term success remains to be seen. But one thing is certain. Levi's is a company in transition, and it will be fascinating to see how their story unfolds in the coming quarters.
It certainly will be, and for our listeners, keep an eye on a few key things. How much will a potential Dockers sale fetch? Will they reinvest it in Levi's or branch out elsewhere? And how will they continue to navigate the challenges facing the apparel industry? It all comes down to what Levi's thinks will bring them the most success in the long run.
Exactly, and that's what makes following their journey so compelling. They're a prime example of a company grappling with complex strategic choices in a dynamic market. Their decisions will have ripple effects throughout the industry, making them a key player to watch in the months and years to come.
All right, well, there you have it, folks. Another earnings season deep dive in the books. Make sure you stay tuned for our next episode, where we'll be tackling another intriguing company and dissecting their financial performance. Until then, happy investing.